You did the hard thing. You said no to the Europe trip everyone else took. You stayed in your SIP when the market dropped 20% and every WhatsApp group was screaming to sell. You lived in a flat you had outgrown because upgrading would have meant stopping the investments. You quietly, slowly, stubbornly built something. And then one morning, you open your CAMS app and the number on the screen reads 50 lakh rupees. You close the app, you open it again. 50 lakh rupees, and here is the part nobody warns you about. You don't feel what you thought you'd feel. You thought you'd feel rich. You thought something would shift. A lightness, a relief, a sense of arrival. Instead, what washes over you in that moment is something closer to fear. Because for the first time in your financial life, you actually have something real to lose. That psychological shift, that exact moment, is what this video is about. And I am going to be honest with you in a way that most finance content in India is not. Because 50 lakh rupees is not the finish line. It is the point where the game changes completely. The mindset that got you here will not get you to the next level. In fact, that same mindset, if you carry it forward unchanged, will cost you crores. Today, 5 things that change the moment you cross 50 lakh rupees, and one brutal truth waiting at the very end that almost nobody talks about. Let's start. First, a reality check that will put 50 lakh rupees in context for you. According to the RBI's latest data, India's mutual fund industry, AUM, crossed 73 lakh crore rupees as of March 2026. That sounds enormous, and it is. But here is the number that matters more. There are 26 crore mutual fund folios in a country of 140 crore people. That is less than 1 in 5 Indians. And within that group, the average folio size is not 50 lakh rupees. It is dramatically smaller. The RBI's household savings data tells us the average Indian family adds approximately 51,000 rupees per year to the net financial assets. Not per month, per year. So if you have 50 lakh rupees in savings, in any combination of mutual funds, FDs, stocks, PPF, you are not in the 1%, but you are comfortably in the top 3 to 5% of Indians by financial asset wealth. That rarity is not a reason to stop. It is a reason to understand exactly what you are holding and what it can do. Because most people never get this far. Here is what the number actually means in real terms right now in 2026. At a conservative 12% CAGR, which is what 30 years of Nifty 50 data supports as a reasonable long-term expectation, 50 lakh rupees generates approximately 6 lakh rupees in a single year just by existing. Without you touching it, without you adding anything, 6 lakh rupees a year, 50,000 rupees a month. That is the take-home salary of a solid mid-level software engineer in Bengaluru or Hyderabad right now. Your money is doing what a professional earns. And unlike a professional, it does not burn out. It does not take sick leave. It does not negotiate for a hike. It just compounds. This is the moment when your corpus starts working harder than you do. And that changes everything that follows. Change 1. Your relationship with risk completely reverses. Before 50 lakh rupees, your greatest financial enemy was playing it too safe. The person who kept everything in an FD at 6.5%, while inflation ran at 4 to 5%, was losing real purchasing power every single year, slowly, quietly, invisibly. The biggest risk before 50 lakh rupees was not taking enough risk. After 50 lakh rupees, the greatest risk completely reverses. Now it is taking too much risk with money you have already built. Here is what I see happen again and again after people cross this milestone. They feel confident because they have built something real, and that confidence quietly turns into overconfidence. They start taking concentrated bets, putting 15 to 20% of their corpus into a single small cap stock they read about in a Telegram channel. They start exploring FNO because the returns in the screenshots look incredible. Here is the data on FNO. SEBI's own studies consistently show that over 90% of individual FNO traders lose money. Over 90%. Not 50, not 60, over 90. And those losses are not small. The average loss among retail FNO traders runs into lakhs per year. At 50 lakh rupees, a 30% market correction which happens, we saw Nifty drop significantly in 2025, means your corpus drops by 15 lakhs rupees. 15 lakhs in a portfolio correction is emotionally destabilizing in a way that a 5,000 rupee drop was not. And when people are emotionally destabilized, they make the worst possible decisions at the worst possible time. The game at 50 lakh rupees is no longer accumulate aggressively. The game is protect and grow. That requires a completely different kind of discipline. Change 2, asset allocation stops being a vague intention and becomes an actual plan. Before 50 lakhs, your asset allocation strategy was honest and simple. Put money in SIP, worry about everything else later. That is not wrong. When you are starting out, the most important thing is just getting money consistently into the market. Allocation fine tuning is a problem for later. Later is now. At 50 lakhs, here is a framework that actually makes sense for someone in their 30s. 60 to 65% in diversified equity, a combination of index funds like Nifty 50 and some flexi cap exposure. 15 to 20% in debt instruments, short duration funds, PPF or high quality bonds. 10% in gold, specifically sovereign gold bonds or digital gold, not physical jewelry where you lose 10 to 15% the moment you walk out of the shop in making charges, and 5 to 10% as liquid emergency money that you can access in 48 hours without touching your investments. Why does this matter now in a way it did not before? Because at 50 lakhs, even a moderate market event has a real rupee impact that can push you into emotional decision making. Proper allocation is not about optimizing returns. It is about keeping you in the game when the market does what markets always eventually do, which is go down before it goes back up. The people who lose at the 50 lakh stage are almost never the people whose funds underperformed. They are the people who panic sold during a correction and never got back in. Change 3, the tax bill you have been ignoring quietly becomes a real problem. Before 50 lakhs, most people's tax planning was exactly this. Put 1.5 lakhs in ELSS under Section 80C and consider the job done. That was fine. Your corpus was not large enough for the tax implications to be materially significant. After 50 lakhs, you are now generating actual capital gains at scale. And if you do not understand the current rules, you will discover the cost at ITR filing time in the worst possible way. Here is what the rules look like as of 2026. Long-term capital gains on equity mutual funds held for more than 12 months are taxed at 12.5% on gains above 1.25 lakhs per financial year. This rate went up from 10% in Budget 2024, and Budget 2026 made no changes to it. Short-term capital gains on equity held for less than 12 months are taxed at 20%. Debt fund gains for units purchased after April 2023 are now taxed at your income slab rate, regardless of how long you hold them. The long-term benefit that used to make debt funds tax efficient was eliminated by the Finance Act 2023. If you are still treating debt funds the way you did 4 years ago, your tax estimate is wrong. Now, here is why this matters concretely. At 50 lakhs, generating roughly 6 lakhs in annual market returns, you may already be crossing the 1.25 lakh LTCG exemption threshold, depending on what you redeem in a given year. That means you owe tax you did not budget for. The solution is not to avoid selling. The solution is to plan redemptions deliberately, spread them across financial years where possible, use the 1.25 lakh exemption every year intentionally. And at this stage of your wealth journey, a fee-only SEBI registered advisor is not an expense. It is genuinely the best investment you can make. Change 4. The lifestyle inflation conversation becomes unavoidable and far more expensive. You're probably in your 30s, your friends are buying cars, someone in your apartment complex just got a 2 BHK in the suburbs on a home loan, your Instagram feed is European holidays and business class upgrades, and for the first time, you actually have the money to say yes to some of it. Here is the line that changes everything. There is a profound difference between mindful spending upgrades and identity-driven lifestyle inflation. A mindful upgrade is this. I have been sleeping badly for 3 years. I am buying a 30,000 rupee mattress because I value my sleep and my health. Identity-driven inflation is this: I need a 15 lakh car because people who have done well in their careers drive nice cars. One makes your actual life measurably better. The other burns compounding at the altar of social validation. Here is the maths that should stop you cold. Every 5 lakhs you spend impulsively after crossing 50 lakhs is not just 5 lakhs gone. At 12% Kajar over 10 years, that 5 lakhs would have become 15.5 lakhs. Every impulsive purchase is not its sticker price. It is 3 times its sticker price in lost future wealth. And India has a version of lifestyle inflation that is uniquely painful. The social obligation spending that has nothing to do with what you want. The cousin's wedding you are expected to contribute to generously now that people know you have done well. The family vacation you end up funding because you are the one who can. The festival that keeps escalating year after year because you showed up with more last time. None of these feel optional, but they add up and they compound in the wrong direction. Change 5. Your relationship with money transforms psychologically and not always in the way you expect. Before 50 lakhs, money was scarce. Every decision was, how do I accumulate more? The emotional relationship was simple: save more, invest more, grow more. After 50 lakhs, a new emotion arrives that nobody in a finance video ever prepares you for: loss aversion. The fear of losing what you have built becomes louder than the desire to grow it further. And this fear, while completely natural and completely human, makes people do genuinely irrational things with money they spent years building. They move everything into FDs to be safe right before a market recovery. They stop their SIP during a correction because watching the number go down feels unbearable. They check their portfolio every single day, making themselves reactive to every piece of news and noise. They start second guessing every decision they were making automatically for years. Behavioral economics calls this loss aversion, and it is well documented that the pain of losing 10 lakhs feels psychologically larger than the pleasure of gaining 10 lakhs. This asymmetry gets stronger as the numbers get bigger. The solution is not motivation. Motivation runs out. The solution is a system that removes the need for moment to moment decisions. Write your asset allocation down. Set a rebalancing rule once a year or whenever any asset class drifts more than 10% from your target. Then stop looking at your portfolio every day. Watching your portfolio daily is the financial equivalent of weighing yourself 5 times a day while trying to lose weight. It tells you nothing useful. It stresses you out enormously. And it guarantees worse decisions, not better ones. Now, the brutal truth I promised at the beginning. After 50 lakhs, the single greatest risk to your wealth is no longer the market. It is you. Specifically, it is your decisions under social pressure, under fear, under the quiet conviction that because you have built 50 lakhs, you now understand the market better than you actually do. The AMFI data tells us that SIP cancellations spike during market volatility and new SIP registrations surge during bull runs. People get in when markets are expensive and get out when markets are cheap. Across crores of investors, this pattern repeats so reliably that it has become predictable. The discipline that built your 50 lakhs, the boring, consistent, unsexy habit of investing the same amount every month, regardless of the news, that discipline is not a phase you needed to get through. It is the entire strategy, and it becomes harder to maintain after 50 lakhs. Not easier, because now you have more to lose and the emotional stakes are real. The version of you that built 50 lakhs got you here. That is genuinely something to be proud of in a country where the average household is adding 51,000 rupees to its financial assets per year. You have done something most people never will. But the version of you that takes you to 1 crore and beyond, patient, tax aware, allocation focused, immune to the noise, that is someone you have to consciously build. And the 3 things you can do right now if you are at or approaching 50 lakhs. First, write your asset allocation on paper today. Not in your head, on paper. What percentage is in equity, debt, gold, and liquid cash? This one exercise will force clarity you did not know you were missing. Second, do a tax audit before you redeem anything. Pull your CAMS or KFintech consolidated statement. Add up your unrealized gains. Estimate your LTCG for this financial year and understand exactly what a Redemption will cost you in taxes before you make it. Third, define your why. What is this 50 lakhs for? Retirement, buying a home without a massive EMI, funding your child's education, buying yourself 5 years of career optionality. Without a why, 50 lakhs is just a number on a screen. With a why, it is a plan, and people with plans make better decisions than people who just have numbers. You already have the discipline. Now get the strategy. Drop a comment below. Are you approaching 50 lakhs? Have you already crossed it? Or are you somewhere else on this journey entirely? I read every comment. Subscribe to Shivani Talks Money for more real finance content every week. And if you want to know the common trap every Indian generation falls into with money, go watch my next video right here.